Hey guys, and welcome to another episode. Market makers often mislead traders into taking positions in the wrong direction, so they can secure the liquidity required for their own moves. Picture an uptrend where market makers aim to drive price from point A to point B. In this case, they need to make large purchases but face an issue. No one wants to sell because the uptrend is clearly visible, so they trick traders into selling by using a simple setup. Then they absorb all the sell orders and push the price higher again. In this episode, we'll walk you through the essential principles behind the market maker's deception and reveal our complete strategy. Not only to avoid this trap, but also to profit from it. So if this is something you'd like to learn more about, make sure to subscribe to our YouTube channel and turn on the notification bell to stay updated whenever we drop new content. Also drop a comment with any questions or thoughts you have, and we'll do our best to get back to everyone. See you right after the intro and disclaimer. So before we dive into the market maker's trading pattern, there are two essential concepts about trends and fake outs that you must grasp clearly. So let's begin with the trends. It's obvious that in an uptrend the market forms higher highs and higher lows. But in reality, price action rarely moves that clean and is usually quite messy. Now take this example. Here comes the question: are we still following an uptrend? What about this point? The answer remains yes, we are in an uptrend unless a candle breaks and closes beneath the current higher low. Now here's another question: which of these lows qualifies as the actual higher low? We need the answer as we confirm the lowest point of the retracement as a higher low only after the market breaks structure to the upside. So in this situation, this point is our lower high, and if it gets broken downward, it could indicate a potential shift in trend. Keep in mind the same logic applies when analyzing a downtrend. So let's put this idea into action using a real chart. Here we can see a downtrend forming with move 1, 2 and 3. Based on what we discussed earlier, we remain in a downtrend as long as the price stays under this high in the following moves. The price breaks the structure downward and prints a new lower low. This becomes our fresh lower high, and again, as long as the market stays beneath this point, the trend remains bearish. The sequence of lower lows and lower highs continues until the price finally breaks and closes above the previous lower high. At that stage, we are no longer in a downtrend and a potential uptrend could be starting. Now that you have a clear understanding of trends and basic market structure, let's discuss fake outs. A fake out happens when the market breaks out of a chart pattern but quickly reverses and moves back inside the same structure. Picture an uptrend where price breaks above a resistance level. So when the price pulls back to this area, we expect it to act as a support zone and push the market upward. But if the price slices right through the level without any reaction, we label this as a fake out. Here's a key takeaway: fake outs show strong pressure from the opposite direction and can be an early sign of a trend reversal. In this case, we had an ongoing uptrend until a fake out occurred and the market turned from that point. Now that you're familiar with the key concepts behind the market maker's setup, let's get into it. So once again, imagine we're in an uptrend and market makers aim to drive price from point A to point B. Let's assume they plan to purchase 1 million shares before the price reaches point B. But there's a challenge. It's clear to everyone that the market is trending upward and prices are expected to rise. So, traders are eager to buy, and no one wants to sell. If market makers place their orders now, price will shoot up to point B too fast, before they can accumulate enough shares. So, here's what they do to trigger selling. They form a range-bound zone, and cause a breakout to the downside. This move tricks many traders into thinking the trend is over, and the market is reversing. So, they jump into short positions. At this stage, market makers step in, collect all available liquidity, and push the price upward again. So, here's how we trade this scenario. When the price returns to the previous range zone, it gives us a chance to buy. We take a long entry, and place our stop loss just beneath the structure, while targeting the next key level. Let's now break it down into two steps. First, we confirm that the market is in an uptrend, until we see a candle close below the higher low. So, we maintain a bullish bias. Second, we detected a fake out, which could signal a temporary shift into a short-term downtrend. And we then execute a buy trade when price breaks and closes back inside the previous range. Here's a key reminder: this strategy works as a trend continuation setup. So, don't use it in every situation. Only apply it when a strong and clear trend is present. Now, let's discuss this trading strategy on a real chart. This is what goes through our minds when applying this approach. Here, we can clearly identify a moving uptrend, and we spot our higher highs and higher lows. So now, we know that as long as we don't get a break and close below this higher low, we can confirm that we're still in an uptrend. After establishing that, we observe the price action closely for possible long opportunities. Now, look at how the market forms a consolidation area and then breaks it to the downside. In this scenario, many traders open short positions, thinking the market is about to reverse and move lower. But shortly after, the price climbs back into the consolidation zone, ignoring the expected resistance from the broken support. This gives us a clear fake out. And this is exactly where we look to enter a trade, knowing that the overall market direction remains bullish. So, we wait for a candle to break and close back inside the consolidation range. That marks our entry point, with a stop loss placed safely below the structure. For our first take profit, we close half of the position once the price hits a 1 to 2 risk to reward level. For the remaining portion, we trail the stop to secure more profit if the move continues. Overall, the probability of the market reaching our target is higher than the chance of reversing the entire major trend. Now, let's take a look at another example, this time in a bearish scenario. Here, we clearly have a downtrend, with a series of lower lows and lower highs. So, we hold a bearish overall bias and will be looking for short entry opportunities. As we continue observing, we can see that, once again, the market creates a fake out by breaking above the consolidation zone and then quickly dropping back into it. This behavior signals strong selling pressure and can indicate a possible end to the short-term uptrend. In this case, we'll place a short entry right after a candle closes back inside the range, with our stop loss position just above the recent swing high. So, guys, that's it for now. Thanks for watching this video. I hope you found some value in this video. If you did, please give it a thumbs up and consider subscribing to our channel for more trading strategies and insights. Also, feel free to drop a comment if you have any questions. We'll do our best to respond to all of them. See you in the next episode.